So it's important to look into this is the fine print area that we're talking about with life insurance policies, and we're looking at it, we're speaking in terms of like the different provisions that are involved in the contracts. They can get quite wordy, so it's worthwhile, if nothing else, to at least read through one time and read that fine print. But so reinstatement of a lapsed policy, if it has not been turned in for cash, time limit of 1 to 2 years. Grace period allows you a late payment without penalty, automatic premium loans, cash values used to pay premium if not paid within that grace period. So it's paying it out of your own account, so to speak. Guaranteed insurability options, clauses in life insurance policy, non-forfeiture clause. You keep accrued benefits if you drop the policy. Incontestability clause. After the policy's been enforced for a while, the company cannot dispute its validity for any reason, including fraud. Suicide clause. This is usually goes into it lasts about 2 years, so you have to, be insured 2 years before you commit suicide. I shouldn't chuckle about this, but these are all things that, of course, that through experience, insurance companies have adopted these clauses. Why you have these clauses in there to protect both you and also the company as well. So when you're the payout, if you will, for these life insurance policy, you have to, of course, name your beneficiary, contingent beneficiary, upon if your primary beneficiary passes away or for whatever reason is not able to collect, then the contingent beneficiary would be able to step in and be able to collect. Misstatement of your age provision pays based on your actual age, of the person. Policy loan provision to borrow against the cash value, up to cash value of the policy itself. Joint life options, the first to die pays benefit upon the death of the first spouse. Second to die, also called survivorship life, insures 2 lives at one time. So there are various riders that would be involved. So these are add-ons, if you will. A rider of policy modifies the coverage by adding to excluding conditions or altering benefits in some way, shape, or form. The waiver of premium disability benefit, waiving that disability piece, that accidental death benefit, double indemnity. So if you die, if you get into an accident, you die, you end up, the policy pays double what would normally be the case if you died for some other reason. Cost of living protection, adjusting for inflation. Accelerated benefits, also called for living benefits paid to those who are terminally ill before they die. For terminally ill patients, if they have 6 months to live, then you can accelerate the benefits again to pay for their expenses, whatever the reason might be. You could, so long as the death is impending, certain. There's some certitude of your death. So onward we go. So buying life insurance, who do we buy that life insurance from? So there are different rating agencies out there, but the most important one to kind of see is the one that you would AM Best or some other rating agency. AM Best is the one that's typical that we turn to. Choosing your insurance agent, talk to your friends and your parents, for example, about any kind of recommendations that they might have. Does the agent have professional designations such as chartered life underwriter? Is the agent willing to find a policy that is right for you, or does he push a certain type of policy within the family of policies that he has, for example? You have to be cautious of these things. Do they ask about your financial plan? Do you feel any pressure in any way, shape, or form? Is the agent available when needed and happy to answer those questions? These are all things that to take under consideration when you're purchasing insurance, right? So typically when we're talking about insurance, what happens is that you have the application, you provide some medical history, and if you're looking for a group policy through work, there usually is no physical unless it's a higher dollar amount depending upon that. Typically, read every word of the contract. Again, as I said before, read it through at least one time. After you buy it, you've got a 10-day free look period to change your mind. The right of rescission is what it's called. Give your beneficiaries and a lawyer a photocopy of whatever that was, the terms of that insurance policy would be, right? After the purchase, after you buy the new insurance, you have about, again, that 10-day, when, again, reading it carefully. If you're not satisfied for any reason, then return the new policy within 10 days after you receive it. And just return it and make sure that you have some sort of dated receipt, registered mail or certified mail coming, from the post office, for example. The insurance company would have to return your premium then within 30 days, etc. So just some stipulations to kind of consider. So paying out to your survivors, your beneficiaries, right? Cover immediate expenses resulting from the death of the insured, death benefit, right? Protect dependents against the loss of income resulting from premature death or the primary wage earner. So this is that the death benefits or survivor benefits. Common settlement options would be lump sum, limited installment payments, or life income option. A lump sum would be paid out in total. Pays that out to in one installment to the beneficiary. Limited installment payment pays equal installments for a specified number of years payments, if you will, after your death. And life income option, payment to the beneficiary for the life. It's an annuity for that person going forward. So there are incomes that that are built into life insurance policies. Some of them, so like for whole life policy, you may borrow against the cash value, or surrender the policy and receive some cash value for that. In other words, you can cash out. People who purchase variable life insurance policies may supplement retirement income by withdrawing some of the investment portion as an annuity. Again, it's a retirement vehicle. It can be used as such. Be careful when you're switching policies. You may find out that you are uninsurable, meaning that if you had a policy for 20 years and you find yourself, maybe you're 60 years old and you go and you want to, to change companies, you have to be very, very careful because you may have to get a medical checkup and you may not qualify for whatever that insurance, or it might become much, much higher, the premiums that would be associated with it. Can you get all the provisions with the new policy that existed with the old policy? This is debatable. Sometimes you can get better, but more often than not, it's not as good kind of going forward. So you really have to be careful about changing your policies. This again is why you have to do your homework up front as much as you possibly can.